It's 2 in the morning. In a quiet room, a handful of people sit around a polished table. Screens glow. Charts flicker. Numbers scroll. They aren't presidents. They aren't billionaires. But by sunrise, your mortgage could be more expensive. Your business loan could tighten. Your currency could weaken. The question isn't what interest rates are. The real question is, who actually controls them? We're told central banks are independent, apolitical, technical, calm guardians of stability. They watch inflation, adjust rates, and keep the machine humming. If it were that simple, we wouldn't see financial tremors every few years. Because an interest rate isn't just a number on a news ticker. It's the price of time. It's what you pay to bring tomorrow's money into today. It's the cost of buying a house, expanding a company, financing a government. And when that price moves, power shifts. The public story goes like this. Inflation rises, so the central bank raises rates. The economy slows, so it cuts them. Clean, logical, mechanical. Reality is more human. Here's how the system actually works. Central banks don't directly command every interest rate in the economy. They target a short-term rate, the price at which major banks lend to each other overnight. That tiny rate sits at the base of a pyramid. On top of it, mortgages, car loans, corporate bonds, government debt. To influence that base rate, central banks buy or sell government bonds. When they buy bonds, they inject money into the system. When they sell, they pull money out. Liquidity rises or falls. Rates adjust. It sounds technical, but it's really signaling, and markets run on signals. Here's the first twist. The central bank makes a move, but the bond market responds. If investors believe inflation will stay high, they may demand higher returns on long-term government bonds, even if the central bank prefers lower rates. That means long-term borrowing costs can rise anyway. So while the decision appears to be made in one room, the real reaction happens across thousands of trading desks. Now layer in government debt. Most modern governments carry enormous debt loads. If interest rates rise by even 1 percentage point, servicing that debt can cost billions more per year. That means higher taxes, or more borrowing. Legally, central banks may be independent. Politically, the environment around them is never neutral. When growth slows, pressure builds. When unemployment rises, pressure builds. When elections approach, pressure builds. No one has to issue a direct order. The incentives speak for themselves. Then there's the global layer. If a major economy raises rates sharply, capital tends to flow toward it. Investors chase higher yields. Other countries may be forced to raise their own rates to defend their currencies, even if their domestic economies are weak. So one decision in a financial capital can quietly constrain dozens of others. This is where the uncomfortable math begins. Raising interest rates can reduce inflation, but it increases the burden on borrowers, homeowners, small businesses, heavily indebted governments. But it inflates asset prices, stocks, real estate, financial portfolios. And who owns most financial assets? Not the median worker. Interest rates shape wealth distribution without ever announcing it. When rates stay very low for years, cheap credit favors large corporations. They refinance debt, buy back shares, acquire competitors. Asset holders see their portfolios expand. When rates rise quickly, smaller businesses with thinner margins feel the squeeze first. The public narrative is simple. We're fighting inflation. We're protecting jobs. Underneath, it's always a trade-off. Creditors versus borrowers. Present stability versus future risk. Short-term pain versus long-term discipline. And then there's something even more powerful than the rate itself. Expectation. Sometimes markets move not because of what the central bank does, but because of what it says. A single sentence can shift billions in capital. We remain data dependent. We are prepared to act. If people believe inflation will be controlled, they behave differently. They raise prices less aggressively. Confidence does part of the work. But if trust erodes, raising rates may not be enough. Over the past decade, many economies became accustomed to extremely low interest rates. Cheap debt reshaped behavior. Governments borrowed more. Corporations leveraged up. Households stretched into larger loans. Low rates felt normal. Now imagine rates staying structurally higher. Debt servicing costs climb. Investment slows. Weak balance sheets crack first. Alternatively, imagine rates dropping back down at the first sign of pain. Asset prices surge again. Risk builds quietly beneath the surface. Either path has consequences. So who really controls interest rates? The central bank sets the lever. Markets apply pressure. Governments carry incentives. Global capital moves without borders. It isn't a single hand on the wheel. It's a network of power, financial, political, psychological, constantly adjusting to itself. And at the edge of that network sits the ordinary borrower. The next time you hear that rates were raised or cut, don't treat it as a technical adjustment. It's a redistribution mechanism, a signal about risk, a negotiation between stability and stress. The final question isn't whether rates will rise or fall. It's this: when the next decision is made, will it be about controlling inflation or about preserving a debt-dependent system that can no longer tolerate the true price of time? If you want to understand how money really works, subscribe now.